Time for chart of the week. We are digging into rates a lot lately because they tell a story that narratives can't fudge. There is a housing affordability crisis and a supply issue, sort of. Now, we're going to talk about the supply side another day, but the narrative around housing is that the Federal Reserve needs to reduce rates in order to pull down mortgage rates. But that's why we've been talking about rates a lot lately, right? That's just not how it works. Remember, the Fed funds rate, as an example, is a suggestion. It's a range of rates, and it's just between banks. Mortgage rates are set by the market, but they do closely track to the 10-year Treasury yield. So because people refinance and there are always new mortgages being written, the 10-year is the closest approximation that the market can get on long-term debt holdings like mortgages. 30 is too long. 2 is too short. So 10 is the Goldilocks number. But the real story is in the spread. So as you can see from the trend lines here, they always track closely in terms of directional movement, but sometimes they pull closer together. Other times they drift slightly apart. So even though rates are coming down, you can see that the spread between them means that mortgage rates are still elevated above that 6% rate. Now, that's a frustrating spot for homeowners with an existing mortgage below this rate because they're sort of stuck in a rate limbo. And it's a terrible spot for first-time homebuyers because the rates haven't been this high for 17 years. And when they were, it was a financial crisis. So the bottom line is that they can pull the federal funds rate down all they want, but if the market isn't feeling it, it doesn't matter.